Welcome to Friday Flows. This is where I cover investment flows for the ETF universe, give investors an idea of what's going on in the markets. Last week was a down week, but this week we had a nice pop on Monday and Tuesday, and it's kind of been sideways since then. But for the week, for the last 5 trading days, this kind of gives you an idea of what investors were thinking. So it was a risk-off sentiment for the most part. As you see, investment corporate grade bonds, high yield bonds, T-bills, a couple different T-bill bonds, more treasuries, some munis, the first time I've seen it in a bit, a couple different muni bonds. And there was still some flows into the equity side. Russell 2000, a couple different S&P 500 funds still took in flows, which makes sense based on the market movements on Monday and Tuesday. But in general, investors were feeling bearish, and we're headed toward the bond side of things. On the downside of flows, as you might expect in kind of a risk-off week, S&P 500 fund, the big one, SPY, was down almost over $2 billion. And kind of the fund that you always see, kind of a risk-on, risk-off sentiment with investors is the Invesco's QQQ. When investors are feeling risk on, you typically see huge flows. When investors are feeling risk off, you'll see huge outflows. So almost $1.7 billion for QQQ this week. Everything else was just kind of broad market and kind of all across the markets. Although the QQQ and VanEck semiconductor are heavy technology, so that that area again risk off sentiments to this. I also wanted to jump into LQD. This is one of the ones that took in the most this past week at $3.2 billion. An investment grade corporate bond. Jumping into this and seeing how this actually breaks down, I was a little bit surprised that people were going this far into corporate bonds, especially on the duration side. So this is a fund that has up to 20 years, and from a duration standpoint, this is kind of a longer term investment bond. I did not think investors would go for duration. I figured everything would be 1 to 2 years or 2 to 3 years, maybe even stretch it out to 3 to 5 years, just to take advantage of these rates as they continue to rise. From a credit standpoint, BBBs for the most part does have some higher end investment grade. So I don't think quality was necessarily what investors were going for with this. I think people were just looking for that return and that yield. And within this fund, the yields are rising. So it's close to 4%. But if you go through individual bonds that are available now, those rates are very competitive with the equity markets. Another thing I wanted to walk through very quick, just kind of show you the difference between overall, just not in individual funds, but overall the flows for the past week, again, from a fixed income standpoint, almost double what equities took in over the last week. So again, very risk off sentiment, investors headed toward fixed income. And, really, why wouldn't you? The yields are continuing to rise. You can get great yields, especially compared to 6 months ago. So, you can get a treasury 3 month, 6 month over 3%. That's essentially a risk-free 3%. And I think investors are taking advantage of that. So we'll see where this continues to move over the next weeks. Election years tend to be good for equities, and we'll see what happens in this fourth quarter. And I will be keeping an eye on it and giving you updates. So I hope you have a great week, and I hope you have a great weekend.